When the VIX is high, you buy. When the VIX is low, you go. What does that mean? That's actually not my phrase. I'm Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Hope you'll check us out at jazzwealth.com if you want to work with an advisor who has nothing to sell but themselves. Years ago, that's not my phrase. When the VIX is high, you buy. When the VIX is low, you go. That's a shout out to Phil Grandy, Phil's gang here he's actually, or was in Sarasota. 20 years ago, I used to deliver menus to restaurants when I was a kid, 22 years ago. And I would listen to his show, just talking about the stock market and stocks that were interesting and stuff. And I found it fascinating. And he used to say, I don't know if he's around still, but when the VIX is high, you buy. When the VIX is low, you go. And that was the one thing that used to drive me crazy about him. What is high? And what is low? Is it a range? Is it a number? What is the VIX, right? Let's talk about it. So that's what we're going to cover today. We're going to do a study on all of this to show you exactly what to look at. The VIX is often known as the fear index. In reality, it's just an option, or it's an options positioning product for the S&P 500. Basically, how fearful are people that the S&P is going to go down versus up? That's the really simple way to explain it. Now, the VIX itself is an index, right? So it's not necessarily tradable. There are VIX futures. There are VIX ETFs, which you can trade. VXX is, I think, probably the most popular one, where you can participate in the rate of change in the volatility index, but you're not actually in it. It's just tracking it. It's like GLD tracks gold. They're investing in gold for you, and you buy the ETF. Or USO, they're investing in oil futures contracts, participating in oil, and you just kind of play along. So VIX gets a pretty popular focus when the market gets crazy. As the market is perceived to become more volatile, the VIX goes up. It doesn't mean it has to go down. Like the S&P doesn't have to go down. If we fear there's an impending event, for example, an election night where we all vote, right, and see the results, it's perceived that the market will be more volatile. Well, it hasn't gone up or down, but the VIX will shoot up. So when the VIX is high, there is more fear. When the VIX is low, there is less fear. Hence the phrase, when the VIX is high, you buy, meaning people are more fearful. There's blood in the streets and the markets are probably falling and, you should be buying that discount. When the VIX is low, you go, meaning take your profits or just go away and don't look at the market, right? So let's take a look at some of the data here. Here is the average VIX pricing based on different events. So if we go inside of here, look, 20 for this plotting point is right about where we would say high versus low. That's not true in reality, but just for this amount of data. So we can look through, if you live through it, the dot-com craze there where everything started falling apart, volatility spiked, average VIX at 27.29. You can naturally assume that there was some quiet years in there. Everything seemed to be recovering a little bit. And then we hit the financial crisis. Real estate, oh my God, it can go down. And so we have this, we're about 32%, which ranks as one of the highest average VIX readings since 1990. Then you move forward and you go, everything was pretty cool. Volatility was quiet. We got used to a calm and slowly uptrending market. Not all the time, but for the most part. And we find, then we get into the COVID issue that we had there, and a VIX, of course, spikes higher. So VIX being high in this case is going to be over 20. That is not the case overall. We're going to expand on this. Now, here are the actual numbers of VIX, where the VIX peaked during different points here. The one that ranks the highest, of course, if you go back to Black Monday, are you old enough? I was only 5, but of course I studied it. I remember learning about this. I told you guys the other day, there's one guy that literally stopped the market. It's a fascinating study. One guy who wasn't even on the trading floor at the time who stopped the market from falling, the futures market anyways. You can see the top reading here. During COVID, VIX hit 82.69. That was the top peak there, which was the highest since the financial crisis, 80.86. You can go through various trade conflicts, Watergate, debt ceilings, all kinds of good things in here just to kind of show where things rank. Now, VIX, when the VIX is over 40, that is considered extreme. And that's not me telling you that. That's just, we take the VIX over the lifetime of it being around. Anything over 40 is considered extreme. You just saw a slide ago. It can go to 80. It could go to 150, right? So that would be hyper extreme. Now, you would never want to short the VIX. I mean, for me personally, I just wouldn't do it because we just saw the VIX can shoot up so fast it would just wipe out your entire account. So those of you that are trading out there with what I'm about to show you, don't think you go short the VIX. You're probably be fine most of the time, but then you'll be wiped out. No question about it. Okay. Now, Let's take a look at how the VIX recedes or reverts back to its mean after having a spike, right? So it's very normal. I'm just going to share this with you real quick. The VIX is a mean reversion product. You get that? So the VIX likes to hang around an average, right? And occasionally it shoots up and gets away, and it likes to come back. And that's just because we get fearful about stuff and then we run away. Think about deer at a pond, and there's 100 deer all sipping water from the pond. An alligator comes and grabs one of them. All the deer get spooked and they run away. Are they never coming back to that pond? No, they'll come back and they'll drink again, right? So the way we break this down is we say, okay, after there was a spike above 40, let's look out in time and see when did it actually revert back to the mean, or at least make its way towards it. So when the VIX spikes above 40, 1 month later, it is 80% of its value. So it went from 40 down to, what would that be? Do the math real quick. Yeah, I can't do the math real quick. So it fell, right? 81% of its value. All right, 2 months later, after spiking above 50, it has now lost what would be 38% of its value. So it's down to 72% of what it was. 54, 62, 4 months later, 59, and 56, 6 months later. So that is every time the VIX goes above 40, it reverts back to it, meaning fear subsides and we all just sort of get over it. Now, the next thing we did, do you like these, by the way? Is this like, am I talking to a wall? Or because I like this data stuff, like just help me out. I'm not doing this for the algorithm or anything. If you like this kind of data, like just give me a thumbs up or something in the comment section, because I'm literally just guessing what you guys want to hear here, just trying to sound smart. Okay, so the next thing I thought of was I want to see when the VIX spikes above 40, all right, or any range really, but I wanted to focus on 40. What is the probability of the market being positive going forward, and what are those forward returns? Right? So then we could really justify what Phil said years ago. When the VIX is high, you buy. When the VIX is low, you go. Is that true? So when the VIX is below 20, forward returns at any point, or when the VIX is below 20, forward returns 8.6%. That's about average, right? That's about what, just shy of what the market does on average. Well, that's also an average performing market where we're not too scared, we're not too happy, we're just right in the middle. When the VIX starts to rise between 20 and 30, average forward returns are 15.3%. Think about what happens in there. The VIX is rising. Oftentimes the market is falling, so we're getting a discount there. Forward returns tend to be better than average. When the VIX is what we would just categorize as high, 30 to 40, forward returns are 21.7%. And when the VIX is over 40, that extreme level, the average forward returns in a year are 30%. What does that tell you? Not that you're going to do anything with the VIX, but that you're going to say, I realize volatility is high. I should be participating. I was putting $100 a month or week or whatever into my 401k. I would like to raise that if you can. I would like to now buy more aggressive investments, an index fund, or spread out and buy the Magnificent Seven or whatever it is that you're into. And so that's the indicator here. That's what the takeaway is. I also wanted to know the probability of being profitable, which I mentioned a second ago. So we'll take a look. When the VIX is low, under 20, 78% chance. Just go all the way on over here. When the VIX is high, you have a 90% chance of having a profit 12 months later if you're an investor. I can't say the word guarantee, right? But that's pretty freaking close, that when the VIX is high, if you're investing during that time period, those dollars are going to see an increase in value over that 12-month period, right? So really, really interesting. So we got some takeaways here. When volatility is high, and now we're saying, well, hey, over 40 is where we put this here. We know it's temporary. We know over the 1, 2, 3, 4, 5, 6 month period, volatility retreats back to its average or its mean. Consider rebalancing. When the VIX is high, there is a lot of fear. Go get the stuff that's on that's discounted. There's also an alternative way to think about that. You could say, I'm going to sell off the things that are not doing so well when the market's falling. And I'm going to take those dollars and put them into the things that didn't fall as much. Keep in mind, if you take that approach, you're actually not rebalancing, you're taking more risk. So the traditional rebalancing approach where you're 70-30, when the markets fall, you're actually taking from the ones that held up that you have a bigger profit in, and you're adding to the things that were weak. Maybe it's bonds or whatever it is. So if you go the other way, just remember you're not actually rebalancing. You could take more risk if you want, but that is exactly what you're doing. The emotional reaction, the data that I share with you is not to show off. It's not to look smart. I hope you think I'm smart. Everybody here at Jazz is smart, I think. Well, we're all family too, so I hope they're smart. Anyways, I share it with you to remove emotion, right? Sharing data, like you guys could go do the same thing, but I do it so that you go, oh, when the VIX shoots up, when the market gets fearful, should I? No, I shouldn't, because now I have the data to back up my beliefs there. Dollar cost averaging. We mentioned that just a little bit ago. When the VIX is high, the markets are falling. If you are averaging in or even adding more money in there, you're going to be just fine. And remember, if you choose to rebalance, which is a form of diversification, careful. Make sure you do it the right way. All right. Lastly, volatility is normal, right? Once in every 10 years do we have essentially a market crash, right? Well, that means higher volatility there. It is also a mean reversion product. I said this earlier there, that VIX tends to revert back to the way it was because we all lose our fear after we're just tired of it. COVID is a great example, right? It was really fearful. And then we just kind of were all like, it's gone. COVID, it just, all of a sudden it's not a thing anymore, right? Is it still out there? Yes. I had a friend that just got COVID actually. He's fine. But it's like, we're just over it. We don't care, right? It was a really big deal for a while. Use it as an opportunity indicator. Use it with a statistical advantage. I would suggest more of an emotional advantage there. And that leads into the last thing about psychology, right? The name of this game as a long-term investor is just not to do anything stupid, right? You can get emotional if you want, just don't do anything stupid. And here I like to share things that make you less stupid, because we're taking the emotion out of it. Not one of you is actually stupid, but our emotions can temporarily make us stupid. Remember in high school, you liked a girl, whatever, she didn't like you, you did stupid stuff to get her attention or whatever it is, right? We do stupid things. So let's use data. If you like data, you can subscribe to the channel, I hope. If you'd like someone who manages portfolios based on data where we don't actually touch your money either, this is not like Bernie Madoff. You keep the money. We're just going to make the investments for you. And most importantly, we don't make more money unless you make more money. Right on our website, you can actually see what it takes to work with us. We don't hide our fees, costs, fun, classes, whatever it is we do. It's right on the homepage, so you don't have to search around and guess. I love that. Hey, hope you learned something here today. If you did, give me a thumbs up. Let me know in the section below. Does this fit? I asked you a few times, like, is this kind of what you want to learn more of? I could talk about this all day long. And yeah, we'll see you when we see you. Adios.